so you should be able to see my desktop with the disclaimer, and I'll just read through a few little reminders. The Capital Discussion is not a broker-dealer or an investment advisor. This presentation or this webinar is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations, and the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And hypothetical computer-simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, let's see if I can get my screen back here. Oh wait, I'm going to be sharing anyway with the calendar, right? Okay, yep. So let's see, economic calendars. All right, we have, let's see, let's start with last week's economic calendar, and you get here from our website at Resources, Calendars, and Economic Calendar US. If you're going to trade currencies like I do, then the international one's interesting. But for this, we're just going to focus on the economic calendar for the U.S. So right now, I've got the week of September 2nd up, and really not, well, a few events went on. So, Jim, did you want to talk about like the ISM manufacturing and the employment situation reports?
Yeah, Tom, you know, the thing is that if you take a look at last week's calendar starting on Tuesday, you know, that was probably the most important report that we had seen for the early part of the week. And the ISM, okay, along with, you know, if you take a look at like the PMI manufacturing, and you can pull up ISM, like for example, if you click on it, it shows everybody how you can click through, and you can end up seeing with the ISM that it came out to be slightly better. You know, we came out to be 59 versus an expected 56.8. But when you take a look at most of the economic numbers there, they tended to end up being stronger than expected. Throughout the entire week later on, even things like the international trade deficit, stronger than expected. Everything was either on par or slightly better until we got to the big one, and that was the unemployment situation report. There we only reported 142,000 new jobs versus an expected consensus of 220. So we were really worried about are things as good as they seemed. Earlier in the week, we had a little bit of volatility, not a lot. You know, we had mentioned last week that we thought that there would be a battle somewhere around 2,000, and that's pretty much what we saw between 2000 and 2010. There were some days where we moved, you know, 20 SPU points or 20 S&P, you know, the big contract points, the E-minis or the SPX. But for the most part, volatility was just, you know, we spun our wheels and we didn't, you know, we inched up pretty much like we expected to end up doing. However, on Friday, we had a larger swing for a couple of reasons. The things that made the market swing actually quite a bit was not only the unemployment report, but then also the news that we looked like we had a ceasefire between Ukraine and the pro-Russian separatists. And that ended up helping to, again, take some of the volatility out of the market, and the market just kind of inched up. The trades that we ended up having on for last week that worked out rather well, pretty much the same thing that we think this week, and that are, you know, shorter-term butterflies in the market, so that we would end up moving up slightly. And like on the SPX or on any of the major indexes, or whether you do the VIX or any of the VIX substitutes, any of those ETNs, that we see volatility just kind of being somewhat flat. However, you know, we have three things that kind of, you know, I wanted to kind of mention in the market. The first one is that we've seen some improved mergers and acquisitions, M&A type of activity. You know, I had been looking at that now for a little while. Today was a good example where Electrolux agreed to acquire GE's appliance business at a pretty reasonable price. Those things don't happen unless CEOs thinks that the markets are in good position for growth going forward. And remember, some of the volatility and some of the things that have shaken up the market a little bit, besides the geopolitical stuff going on in Ukraine, was that they're afraid that interest rates are going to end up going up because the economy has been getting better. Well, it still has been getting better, but interest rates going up because the economy is getting better doesn't set off widespread panic. So that's why when I take a look at one of the trades to be able to end up trading this, neutral to slightly bearish butterflies on the VIX or VIX substitutes seem to make a lot of sense in this environment. We have a couple of events that have traditionally been not high points, but at least that we've seen markets come down after that. Traditionally, the September-October timeframe has never been a good one to end up being long the market. Tomorrow we have Apple's announcement. If you take a look throughout history, Apple announcements have usually marked at least short-term highs for the stock. And as go Apple, so does a lot of the technology companies. And then the last piece that kind of ends up worrying me is that when you end up having these frenzy IPOs, a lot of times you end up getting sell-offs afterwards. Even though things like Facebook are up now, you remember what a disaster, their IPO was, for a period of time after the initial public offering. And right now we are in full-blown Alibaba tour mode, if you will, where they're going and they're doing all of the talks and speaking around the country as they end up doing their IPO launch. We have a scheduled IPO date of next Friday. That's why looking at these. That's why looking at some of these, shorter-term butterflies and everything that I'm doing in the IRA account that we show sometimes. They've been in really good shape, but I don't want to end up putting these things on past next Friday. After we see how the market has responded to, Apple and Alibaba, and we have a little bit more information on it, we could be in a very, very different situation, in 2 weeks from now. So I'm comfortable this week. I'm comfortable going out to next week with my shorter-term trades. The only thing that I have on really longer-term is some hedges. Like, for example, I have some hedges where I bought some October call spreads on the VIX, like long the 13, call, and short the 23. I also end up having a 25-point wide wing butterfly on the SPX for the end of the year. There's at least a reasonable chance that we can end up having the bulls and the bears just fighting one another, and when we're on December 31st, we're still fighting over 2,000. So I thought that the $25 wide butterfly for $2.30 when I put it on was a pretty good trade. Could it run out? Without question, it can. It probably will. But I just thought that there's greater than a 10-to-1 chance that we're still fighting, and they're going to pay me 10-to-1 if we land on 2,000. So therefore, I was pretty comfortable with it as a risk trade. It's more of a lottery ticket type trade. So those are the things that I've been doing. But one of the things that I wasn't affected by, Tom, was that Europeans were pretty busy this past week, and the euro moved around, and some of the European interest rates moved around. How did that affect your trading on the euro side?
Well, if you go, I don't know if people trade currencies, they should know about the daily Pfennig, and I've got the URL up for the archives. But if you go back to the one on September 5th, they were talking about the European Central Bank. I'll just quote it, did a rate and increase. They cut a rate and they increased a rate yesterday, which was the 4th of September. They cut their refi rate 10 basis points and increased their negative rate on deposits. But the reaction to that, I'll even pull up a chart of the euro, was pretty spectacular. It sold off 200 pips, which in euro terms is a pretty big move. And we're actually trading below the place. We're at a one-year low at this point. So if I pull up a longer-term chart, say 5 years, you can see we haven't been where we are now since, July of 2013. And it looks like it has room to go lower, but, it's who knows how far it's going to go. But, yeah, that was a big move. I had a weirdo on that, on the Euro futures options, and had to do a little defensive maneuvering to get the T+0 kind of flat. But that's what the impetus was that caused that, was the ECB. I did want to circle back to the U.S. thing. There's a fairly new report that's coming out tomorrow, the JOLTS report, and that's the the acronym is the Labor Department's Job Openings and Labor Turnover Survey. So did you want to mention that? Because you're the one that told me about it, Jim.
Yes, I mean, one of the things that I had looked at with that is that the labor numbers, the unemployment, okay, and you take a look at the participation rate, and they started calling it the labor situation report. They just don't want you to look at just the unemployment percentage anymore. One of the things that they took a look at here is how many job openings there are versus how many people are looking for jobs. And one of the big problems that has been occurring is that there are a lot of job openings, but not as many qualified people, so that employers are starting to report that it's harder to find the workers that they're looking for. So what this ends up meaning is that the unemployment rate as a percentage is going to be a little bit higher than it normally would have been before we start to see some wage pressure for them to start to move up. So a lot of the Fed presidents, the regional Fed presidents, and economists have been talking about participation rates and job openings. And so one of the things that on this JOLTS report that they show is basically what are the job openings, the JO, versus what are the turnover of some of the employee rates. And so it's a decent report that at least over the next few months, I will be keeping an eye on. And it's one of the new ones that we haven't introduced to everybody. So I thought it was an important one. If you click on the report, you'll see just a preview of what they expect.
Yeah, I'm looking at it right now, sharing my desktop, so we can all take a look at the chart. It's interesting.
So,
the only other thing I see coming up for next week that's super significant is the FOMC meeting announcements on Wednesday the 17th, right before expiration. Do you have any feeling of if that might affect the market, if they have anything to announce?
As with all Fed announcements, when we're in this point of inflection type of period, we will probably see some type of movement one way or another. Like with the last ones, we may see a movement only to see a retracement. So I don't expect to see anything large. The Fed has been trying to telegraph, I think, pretty clearly with what they've been doing. We will end up seeing increased volatility, meaning the price of the VIX or the options that we're looking at will probably move up a little bit going into the meeting. And then afterwards, depending on how much the sell-off is, if there is one, we could end up seeing the vol stay where they are or go higher. But normally, at least from a probability point of view, it does make sense to sell volatility going into these things, because if the market doesn't move very much, vol drops. If the market goes up, unless it shoots up like through the moon, vols drop. if the market goes down a little bit, the vols may drop or stay the same. The vols only go up if we have a significant drop or if we just have an absolute run beyond belief where people get scared and say, oh my God, I don't even know what's going to happen anymore. But unless you're in like a dot-com boom territory, you don't worry about that too much. The only way vols can really go up after the meeting is if we have a significant drop, okay, after the announcement, and there's uncertainty that the drop will continue. So that's why I tend to like to end up selling into those things, but sell them with defined risk. I don't
Right.
ever like ever being naked.
And I noticed that Friday the 19th is quadruple witching. Anything we should watch out for that?
The quadruple witching, okay, days aren't, I think, nearly as influential as they once were. I think they're traded so much now beforehand that not a lot happens. So, however, again, statistically speaking, sorry about that, I just signed on, okay, as we're going. Statistically speaking, there is upward pressure on the markets during expiration week. So on that day, okay, between now and next Friday, I didn't just pick that randomly. With upward pressure next week, we call, statistically speaking, in history, that it's expiration week. We're going into the Alibaba IPO on Friday. I don't see any catalyst, okay, for there to be downward pressure on the market over the next 2 weeks, unless we have, an escalation of some geopolitical issue, whether it be on, a mountaintop in Syria or, greater involvement in the U.S., where there's fearful in the Middle East that there's fear that ISIS may end up doing any damage towards oil fields. Those are the types of geopolitical things that can end up occurring at any time. Short of that, I don't see anything that ends up putting downward pressure on the market at this point. And given what's happened, I end up expecting the market just to end up staying flat to slightly up over the next, week and a half or so. And for us to take a real hard assessment, next week, for the week after, and the week after that.
John Dory points out that the anniversary of 9/11 could have potential implications. What's your take on that, Jim?
It can, certain organizations would like to end up trying to make an issue of it, but I'm not a big fan of talking about 9/11. I was in New York City on that day in my office, and it was pretty horrific. I don't think that it's probably more symbolic than anything else, okay, when it comes to the market these days.
Right. Okay, well, I think that's it for the questions. Any last-minute words before we call it a day? I don't want to keep everybody too long. Everybody's time is precious.
Tom, the only thing I'd end up saying is I think that we got a pretty special guest coming up on Thursday. Would you just do a quick intro about Len?
Oh, sure. Yeah, the founder of OptionView, Len Yates, is going to be our guest on Thursday. Now, Len's been programming with OptionView for, I think 25 years or more, and he's a pretty clever guy. I actually met him in Chicago, back in 2007, I guess it was. And really smart guy. He's spent a lot of time getting all the volatility models in OptionView working great, and he's going to actually show us some of the intricacies of OptionView, and I think he's got some new tools for doing earnings plays. So I think he's going to show off some of those too, which is great. But Len's going to be on Thursday at 4:30 on the roundtable, and I look forward to seeing him.
That's great. I do also. While we don't have a specific date yet, I also have a colleague, a former Goldman Sachs trader, who trades a lot of earnings plays with options. At some point in the future, I'll end up inviting him to listen to Len and see how Len's tool ends up working. Unfortunately, for our listeners, a lot of the analysis that my ex-Goldman colleague ends up using is Bloomberg. And I don't think a lot of people want to spend $2,100 a month on an investing tool.
Probably not quite yet. So.
I don't want to spend that, okay? And I run a fund.
No. Okay, Jim. Well, I appreciate your inputs. And let's see. Oh, this is my first meeting. How do you register for the Len Yates webinar? Well, John, I'll make sure you're on the list, but you should get an email the day before in the afternoon with the login and also half an hour before the meeting starts. So I'll make sure you're on the list. If you're not on the list, just go to our website, Capital Discussions, and you'll see a banner up at the top. If you click on that, that'll take you to a page where you can click on a reserve my seat and put in your name, email address, and that will also get you on the list. So pretty easy to do.
Tom, thank you very much.
Okay, thanks everyone. Take care.
Bye now.
Bye.